Hello, this is Mike Swanson of Wall Street Window. It's been an interesting week. A week ago, I was visiting David Skarica at his place in the Bahamas. We did a couple videos. One of the videos, we talked about the troubles that were impacting Facebook, probably going to make it drop more. We also highlighted the balance sheet problems of Tesla. It's exploded completely this week. In fact, this morning, the Wall Street Journal actually had a front page article going over the stuff we were talking about with the bond debt. We looked at the balance sheet, but most people are more worried about the stock market. That's what they're invested in. They got their exchange traded funds. Most people watching this aren't fully invested in Tesla, but if they have it, it's a small position. And today, the S&P 500 is closed right on its 200-day moving average. A couple of weeks ago, when it did that, it immediately rallied. Robots kicked in, sent the market higher for several weeks. And I'm going to pull up a chart so everyone can see the situation we're in and ask you, Dave, what do you think is going to happen? Can robots come in and bring us back up to
Well,
2,100?
I'm going to show a chart in a second now. Just let me get it up. I was just looking at.
I got one right there.
No, but I'm going to show an old chart.
Okay. But people are expecting a rally back up to 2,800. They want, or not only expecting it, they badly, I think, in some cases need it. I mean, if someone's on full margin right now in this situation, I mean, 150% or more invest in the stock market. And we've had record margin debt going into January. They're now in a very scary position because if the market were to drop again like it did last month, they could be down, 30, 40, 50% by being on full margin. So a lot of people are kind of scared. I mean, most people aren't doing things like that, but it's still, a scary situation here. And people, are kind of on the edge because the market's on the edge.
Well, like what I was going to show, this is really simply, this is like the 2007 stock market going from about this right about the same date we are right now, the end of March to the basically end of the year. And what I would think, nothing's going to be exactly the same, is that this decline here in July, August is similar to the decline that we saw in February. This rally here in August, September into October was similar to the rally that we just saw in February and March. And then this decline here in October, November is similar to the decline that we just saw. And as you can see, after we kind of got back to those summer lows in November on the S&P, I'll get the Dow up, on the Dow, and now we'll get the NASDAQ. On the the NASDAQ actually it did perform better, so it stayed above the summer lows here. But what we can see is we just had these little bounces the last a couple weeks in December. Then the market topped out in December, and actually, if I just make these charts go 1 month longer to the end of January of 2008, you'll see that in January everything began to break down. So the NASDAQ broke down. The S&P broke down.
Yes. So that red line in that last chart is the 200-day moving average, and it bounced in November, right?
Yeah. In November, it broke the 200-day, and then, the NASDAQ held it, but the other two, I don't know what just happened there, but the other two just broke this is now the current one. But anyhow, I already showed those charts. So it broke the moving average. We came up back through above it, and then we broke it again. In January, everything broke down. So, but here's the thing. To me, that is the absolute best case scenario. And that. So just think about that. That is the best case scenario. That all we're going to do probably is bounce off these lows, for a couple weeks, then end up breaking down. That would probably mean we break down in May or something. And that's the best case scenario. So the thing is too that the market is much more parabolic. It's much more overvalued now. By the end of 2007, we get the Fed beginning to cut rates at least. So, they're still in a tightening mode now. So that's another negative. So I think that could happen. We could see this bounce here at, these support levels. But I think more than likely we could break down here and then have another rally. So maybe break through the 200-day moving average, which you can see the Dow is only about 500 points above anyhow. And then if we break that, say we'll probably quickly smash down 5 to 10% from current levels, and then maybe rally back to the moving averages and falling part again. And I did this series called "It's a Past Prelude" on my website, okay? And I recently did, and so what I did all through the last few months, I did all these podcasts. Here's my website here where you can see it. And I'm talking about mispricing of assets. I'm talking about valuations. I'm talking about past bear markets, 06, 73, 37. I think the most important one, and the one I kind of feels like it to me, is Nikkei in 1990. And this last chart that I put up here, what we can see is this is a correlation of the Nikkei from 1988 to 1990 compared to the S&P today. And what we can see, there's a 98% correlation. And if that were to happen, see this tiny little bounce that happened here in the Nikkei? That's all we're doing right now. And we'll break down, and you see, according to this chart, the S&P could break down to about 2,300 or so, which would be, I guess what? Where's the S&P right now? At 2,600?
Yeah.
Yeah, about 300 points or 10 or 11% from the current level. And then we would probably have, and then there was a good bounce on the Nikkei then. The Nikkei actually bounced from, after falling from 40,000 to 28,000, 39,000 to 28,000, the Nikkei actually bounced back to 33,000. So, I would think then we probably would bounce back. And then probably this moving average, which is representing support here, you can see the market bounced right off the 200-day in February, will then represent resistance. The moving average will start to flatten out and then even fall. And again, if we go back 10 years and go look at the bear market here, you can see the far left is 2008. This rally in the first half of 2008, which lasted from about March to May, got us back to that moving average. Then we failed there and it came down. So just like this moving average, really since the low in 2016, has held virtually every little decline that happened since 2016, and it also held most of the declines from 2012 to 2015. That moving average will probably then represent resistance. So I think a realistic scenario is, if we do break here, is to go down to this 2,200 range, bounce, and then really fall apart after that. And I don't know. I think it could get really ugly, especially over the second half of this year.
Yeah, well, I mean, it's obvious that the leadership of the going into this year has been the technology stocks. And when the Dow peaked out in January and fell 10%, we had the rebound. The robots saved the day on the 200-day moving average on the S&P 500, really, and the Dow, on that recent drop. And what's interesting, though, is when we rallied back up in February, the NASDAQ made a new high when the S&P went up to 2,800. And that rally was led by stocks such as Netflix, Google, Amazon, NVIDIA, the big cap wonder stocks, along with some bank stocks. But when that rally stalled out, everything went straight back down. Now we're back on the 200-day moving average. But what's troubling is those are the leadership stocks, and now they're starting to break down. So we have seen Facebook, of course, break down, and Tesla, of course, break down. But so has stocks such as Google, which went right back up to the high, and now it's actually closed today below the 200-day moving average, just got slammed down. In fact, I think Google is a good representation of what's happening overall in the stock market. We're hanging on the 200-day moving average. That doesn't look like, it did. This stock did go green. It went up 9 cents today. But that doesn't look like it's in a position to rally straight back up. It looks like it's going to pause here, float a couple days, and probably go lower, most likely. Maybe it goes up 50 points. I don't know. But to kind of go along what you're saying, there certainly doesn't seem to be upside potential in the stock that makes it worthwhile buying right now. And frankly, I wouldn't want to hold it. I certainly want to have 100% of my money in that situation, in a stock like this that's gone up for as long as it has. And here we look at the S&P 500 today. Uh, it closed at 2605, but it went down to 2593. Well, that's not much, a big deal, but it is a big deal when 2593 is only 5 points away from where the 200-day moving average is. Now, we haven't closed below the 200-day moving average for so long. The robots held the other week, and I'm fearful that, I do think they're going to come in. I do think they will try to buy tomorrow. Maybe they can make the market go up tomorrow. That would be nice to see, give people more time to think about what's happening. But, if we can bounce like you're looking at the 2007 example in November, December, if we can bounce for a couple of weeks, that certainly would be a nice thing to see happen. But, even if it were to happen, I don't think this 200-day moving average is going to hold for the rest of the year, certainly. And if that's the case, I don't really see why this market's worth risking a lot of money in anymore. I would want to pare back my long positions if I was fully invested. And if I was someone that has been fully invested, has been uncomfortable with the swings going on, I'd want to start to do something different. Now, the problem people have is when they see the market moving up and down like this, they start to think, well, I'm going to start to trade it now. I don't want to hold it anymore, so I'm going to start to trade it. And they start trying to do that without any real strategy. They end up just buying when the market goes up a lot in a single day, like it did Monday, thinking, oh, this is the start of the big rally. Then they get tricked, and it falls, they sell, and they try to buy on the next big rally, and they do this. I've seen this in the last two bear markets. That's what people tend to do. So people need to do something else. And we're both doing different things, but what are you telling people to do right now?
Well, actually, my service, we just recommended, I already had put options on select companies, but I recommended a whole bunch more in just the past few days because, when I saw that, okay, I think we could be retesting these lows, and look it, if we bounce off these lows like that 2007 scenario or the whatnot, and then I think, okay, you can just add to those short positions or add even more short positions when that bounce comes. But if we break here, many of these stocks are going to break badly. Remember, if we say dump to 2,300 on the S&P, you're talking 11-12% loss from this current, where we are right now, or 2,400 or wherever it may be. And, we're talking like 8 to 10% losses. But many stocks will fall, and we're seeing this with like Tesla or Facebook, will fall 20, 30, 40%. So that's what you're trying to do when you're short. I'm trying to find overvalued companies. But here's another thing I want to show you that's really quite interesting here.
Okay.
If we look at this is stocks over moving averages. And if we go look at this, what we can see, the most important one is the 200-day because that's the longer term. But even the 50 is important too. What we can see on this rally, even the 20-day, which is short term, none of the moving average stocks over these moving averages got close to the high at the beginning of the year. And on this recent decline, you can see at the 50-day almost got lower. The 200-day did move lower. And what we see in the last bear market, actually most stocks peaked in early 2007. And the number of stocks trading above the 200-day moving average was going down basically the rest of 2007 and then bottomed out with almost no stocks trading over the 200-day moving average during the crash in 2008. But now we can kind of see a similar kind of erosion occurring here. And what's interesting about this erosion is the last two real corrections we got, this being 2014 when there was a intraday correction, I think about 11%. I think the closing was 8 or 9. And then 2015 is the same thing. The stocks over the 200-day moving average was on this like kind of descending pattern, and then the market actually broke later. So I think this is really important, the fact that this has finally happened. In 2016, when we saw small sell-offs after the Brexit vote, right before Trump got elected, we didn't see this. We saw actually, you can see in mid-2016, we saw the stocks over the 50 and 200-day moving average go back to the highest levels since 2014, 2015. So I think that this now kind of descending and many stocks breaking through their moving averages is really, really kind of important. And what I think what's interesting about this is that I just mentioned 2007, even though the market really peaked at kind of a double top in July and October, the stocks over the moving averages was actually going down the whole year. But I think now, because we have even more robot algorithm trading, ETF inflows driving the market, all stocks were kind of just moving up together. And then that first smash kind of caused many stocks to weaken. And now we're seeing that happen after the top rather than prior to the top of the indices. And I think that robot trading really does make a big difference in that regard. That once that smash, and then once you're not just getting this blind robot buying, that no volatility trade is dead, and that money just flowing into all stocks. Now you're seeing many stocks break down. And I'd also like to note that I think really Tesla breaking down, Facebook breaking down. This is really, really important because these are stocks that have been, like you can see Facebook, we're talking about this 200-day moving average, has just held that for years and years and years. Whenever it got close, it would just, the closest it came to breaking down was late 2016. And then, it stayed there for a few months and then started ascending again. So Facebook has only had very, very minor corrections followed by this steady upward moves. And it breaking down like this and breaking through the moving average is really, really key. And if you go look again back at past bull markets, what you'll see is a lot of these leadership stocks or one or two of these kind of big name fad stocks, if you want. In 2000, it was like Microsoft and Lucent both started getting hit over the first half of the year. And then now, we've got Facebook and Tesla. And I remember a hot IPO stock in 2007 was Crocs, and Crocs in November of 2007, so right near the top of the market, they had a horrible quarter and the thing completely fell apart and gapped down and started on this huge downtrend, which Crocs, by the way, ended up falling from $70 to $1. So I think that when you see these stocks starting to kind of do this, that's also really important because, they call them the FANG. Like Facebook is one of them. Google is acting very poorly as well. You can see Google now below the moving average and kind of up against its lows this February. So when we're seeing these kind of FANG stocks, starting to roll over, Facebook, Google being two of them, and Tesla's kind of in there of one of these key stocks as well. And I always say the FANG, you can spell with two N's because I think NVIDIA, I would actually include them in the FANG stocks. I think that once now that these things are rolling over is really, really important. And by the way, I'm really surprised that some of them are rolling over this quickly because usually these kind of stocks, maybe I just mentioned one or two would blow up at the beginning, but also a lot of them, these stocks tend to go at the end. Like Amazon was one of the last stocks to crack in 2008. Yeah. So I'm also surprised that these leadership stocks are starting to act so poorly so quickly.
Yeah, I'm surprised too. I mean, in the 2000 bear market, a lot of internet stocks blew up, just like Bitcoin blew up, and some of the Bitcoin stocks blew up completely. But Cisco actually held up for quite a long time, just like Amazon did in that bear market situation of 2008 that you just cited. But one thing about, I remember you were short Crocs in 2015 and made a nice score of puts on it. And that stock crashed. And there are a couple other stocks that crashed in 2015 too. But I want to point out a couple other stocks really quick besides Tesla that are, I'm not short this. This is a stock I actually tried to short and haven't been able to get the shares. The symbol is New York, Empire Resorts. It's a small casino, and you can see it's collapsed in the past week. I couldn't get the shares, so I wasn't able to short it. But another stock that's kind of fading is Caesars. It's broken support at $12. I'm not short this stock either, but I was trying to short it at 12.5. I couldn't get the shares. It's fallen like 15% since then. Another Riot, of course, that we talked about multiple times last year, and actually just the other week, warning people to get out of it. It broke 10, and it's just
By the way, this is why I really believe your kind of blockchain Bitcoin thing is kind of done now. Because when you look at a stock, like I got the right chart, you can see it up there, right? I got it up there right now. Yeah, you can see I got it. You got it up, and I got it up. So, so when you go looking at right here, this is just a total pump and dump, like parabolic blow off and then crash, right? And then see, I just say I don't have any positions in these stocks, but when I was considering shorting a lot of these things, this is BTL. This is a Canadian one that got into blockchain. Can't really see it there, but let me get you see it on a 2-year chart on a linear scale. You can see there, like this thing totally just pumped and dumped. And these things are actually now trading almost to where they were before they announced all these moves into blockchain. Hive, this is a Bitcoin miner. You actually mine Ethereum. And same thing, you can see the pump. You know, the stock came out with just under $1, pumped to 6 or something, and now it's $1.28. So when I look at these charts, these are classic parabolic curve charts and crashes, right? And it just looks kind of over. And like you said, like if you go look at what a lot of these .coms look like in 2000s, this is what they did. They blew off like this, collapsed, and then the next move down would just be this slow, grinding move with only very small, marginal rallies, and just kind of, you know, disappear into oblivion, which is probably going to happen to a lot of these crappy blockchain and Bitcoin-related companies, you know?
Well, I just want to point out that these examples of, you know, things like Tesla, Facebook, and some of these smaller ones, forget about the Bitcoin blockchain stuff because they're like very speculative. But, you know, casino stocks crash, a couple casinos really dumping. There's lots of stocks just dumping. I mean, there's no other way to put it. We saw many Dow stocks break down this last month. And we have not seen so many individual stocks get smashed like this since the fall of 2015, which is when you were buying puts on that Crocs and a couple others. Since that fall of 2015, I think it was October that happened, this situation of individual stocks blowing up has not occurred until now. I would suggest that if people don't like to think about the idea that this is like 2007 or 2000 and we're having this big bear market, at the very least, we're going to have a correction that's continuing. It's not over. And that last real correction in the stock market started in July 2015 and ended in January 2015. And now is the time period of these individual stocks blowing up. And the NASDAQ fell a little over 20% during that correction. And we haven't even gotten to that point yet. So we seem to be just having a pause on the 200-day moving average. Neither one of us really thinks the stock market's going to crash or something, you know, over the next couple of weeks. I mean, it's possible because we're now in a risk situation. But, you know, if we fall 15 or 20%, I think they're going to have a bounce or counter trend rally. And if that happens, people are going to think, well, that was just the correction. But regardless, right now, we're in a downside situation, you know, at least a correction of 20% or something on the NASDAQ. And people got to be prepared for that, not try to chase the Monday rallies and wonder days. Even if we go up for 2 or 3 days here, it's really time to be very patient about buying and reduce risk. If you're on margin, get off margin. There's so many people on margin. We have record margin debt. They got to get off of it, Dave. They got to get off margin.
Well, what I'm showing here, I'm just going through these charts. So what I want to show you, these were like stocks that you're talking about this correction. And we're talking, remember, because we're talking about these kind of fad sectors right now, like blockchain or you know, Tesla itself or whatnot. So this is 3D Systems, like a 3D printing company. And what we can see with this stock is, you know, this fell. This was kind of like the blockchain of 2014. Everyone was hot on these 3D printing stocks. I had a friend of mine who told me that his janitor owned DDD, right? And this stock went from, you know, $10, $20 to almost $100. And you can see during that 2014, 2015 period, during that correction, this stock fell from 90 to 11. Another one was SSYS. right? And you can see this stock, same thing. This thing collapsed, from 130, during that correction of 15 to 16 to under $20 a share. Okay, so this is, and then another fad was these Chinese consumer internet stuff. So this is Bida, which is an online cars company, similar to like Auto Trader, something like that, right? And this thing went, you can see, from 90 to $20 a share in 15, 16 during that correction, right? And then this is Vips. This is a company that sells clothing online in China. And same thing, you can see this thing, after going straight up from a couple dollars to 30, this thing fell during that correction to $10. So what we're trying to say is, even if this is just a correction, these kind of fad stocks that ran straight up, don't think that they're just going to only go down 10 or 20%. And we've already seen it with these blockchain stocks. We just showed you the charts. These things are already down 60, 70, 80%, right? And that doesn't even take into account the coins themselves, right? Like the coins themselves, the Ethereum is off $1,000 from its high, from 1,500 to about 400 or 500 right now. So that's the warning too, that even if this is just a correction, and I don't think it is, I think this is a bear market, that these fad sectors, look what happened in the last correction. These fad sectors, these Chinese internet stocks, these the 3D printing stocks, these things all went down 80 to 90%. If you even look at Tesla during that last correction, Tesla went from 275 to almost 130. It went down 50%.
That's brutal. Just that kind of percentage drop. It came back, but it's still very brutal. I'm going to say this one more time, and I won't say it again. But this is advisorperspectives.com, and this is the latest updated margin debt levels, and the latest figures say that they're available to the end of January, and it went up 3.6% in the month of January, and it ended with margin debt, a completely margin debt. In the stock market, it corrects 20%. That correction is not going to be led by the conservative investor that's got half their money in bonds and half their money in the stock market. It's going to be fueled by these margin debt maniacs who came into the stock market, bought more and more every week last year that the market went up, and they amassed record margin debt. So if the market just pulls back 15%, a lot of these people get margin calls. There's going to be forced selling, and it's going to be a brutal, couple of days whenever the correction ends. But there are the people that are creating this dangerous situation the stock market's got into. It's these margin debt maniacs, and I just prefer to step out of the way before they end up becoming forced sellers.
Well, I got a chart here of the margin debt, and the red line is margin debt, and the blue line is the inflation-adjusted S&P 500. And what we can see is that, as you're saying, you look at these spikes here in 2000, 2007, and now we've blown this away, the amount of margin debt. Like the 2007 high was barely higher than 2007, right? And you can see now, adjusted for inflation, margin debt has blown this all away. So there's going to be a reset, and you're going to see a big decline in margin debt. And usually the way you see a decline in margin debt is people just don't take profits on the way up. You can really see it here, right? Yeah, you can look how much higher we are than these two tops in 2000 and 2007. The way you start seeing margin debt go down is usually the market has to see some sort of shakeout. And look at just since that little correction here into 2015, 2016, just look at the absolutely huge move higher in margin debt. It's up almost 50% in just just 2 years.
Well, I think one of the big things that happened is last year the stock market went up without ever pulling back. The Dow didn't even pull back 5%, nor did the S&P 500. And one of the most popular trades became to short volatility, short the VIX ETF, and it seemed like easy money because it just went up, up, and up, and up, and up. And then in January, that ETF completely crashed, and it's being delisted, and everyone who put money in it is getting basically nothing, or like they're losing 95% of their money, and they're getting 5% back or something or less.
Just quick, I also have the VXX here, which is going long the VIX. So on top of the XIV, which blew up, people like something like 80 or 90% of the float of this VXX was short, meaning that all people were doing is shorting this because volatility kept going down and this kept going down. So if you shorted this in April last year, you can see it was like $70. Well, this thing fell to 25. But what's happened is those shorts got whacked. And this is the opposite, by the way, of we're talking about don't be long margin. Well, also don't be short volatility, because you can see what happened is if you were dumb enough to short this last year, you lost all your money, because if a stock goes up 100%, you lose all your money short. So this thing goes from 25, now it's 50. So anyone who shorted this from, say, about the middle of December to the middle of January has basically lost all their money, and so that's a trade that's basically done now. And yeah, there's an estimated something like in all these instruments of either being long the XIV, I don't know, owning puts on the VIX, being short this VXX, whatever it is, it's estimated that no volatility trade got as large as 2 trillion kind of nationwide.
That's crazy. But it shows, when that trend,
I mean, worldwide,
right there was going down, 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 and then it goes straight up. I mean, but when it was going down, it seemed, we're just like trying to say we're in a different market now, and the environment we were in last year, where the stock market doesn't even move. I mean, the Dow didn't even move more than 1% up or down, but 3 days. Now it's doing that. Didn't do it today, but it's done it like 4 or 5 days in a row just in the past week. And who knows how many times it's done it since it peaked in January. And that's what we're in now, these wild moves up and down. And people have to realize what that means is, it means just buying something when the market has an up day doesn't really work that well, because there's a lot of whipsaws in this market. And
that's one thing too. Is see, the thing is about a normal bull market is you usually get these corrections every year or two, right? And because of that, you usually even get punished in a bull market for buying the highs. Like, for example, when I started in the mid to late 90s, investing and trading in markets, in 96, there was almost a 10% correction. In 97, there was a 13% correction. In 98, there was a 20%, 19% correction in the S&P. In 99, there was a 10% correction. So what I'm saying is, even then, if you bought that high, you lost money during these corrections, and then maybe it would take 6 months to get your money back. But with the unnatural way this market traded, really from 2016 and 2017, where you essentially had this no volatility market and not even 5% corrections, that made it even worse, because people did not even get punished for buying a high in a bull market. They could just buy something, maybe at the worst, you see a couple % drawdown, and probably always 30, 60, 90 days later, you were seeing these things, going back to new highs. And there's actually one more thing I'd like to show you here, which I think is really important, is this is the new highs to new lows. And you can see, for example, today there was only one new high in the S&P 500. There were 7 new lows. Now, that's not an extreme amount of new lows, but you can see really, again, when that market began to sell off in January, that kind of just ended these really, the strong internals we were seeing, where, 100, 125, 150 stocks in the S&P were hitting new 52-week highs. Even on this last bounce, this barely got over 50. And you can see the new lows really expanding. But also, it should also be noted this. Those new lows are not extreme. You can see what happened during the 2015-2016 correction. We're still seeing pretty moderate new lows. So all the signs are here right now that the internals are beginning to roll over, everything's shifting, but we're nowhere near the extreme amounts of sentiment we have to see. Like, I don't know. Actually, I didn't look at, Mike, did you see the investors' intelligence numbers today?
Yeah, the Bears were like 17% and the Bulls were like 45 or so.
That's just insane. Like, all that's happened is people have just gone from being bullish to being neutral, right? They're only 17%, even with this volatility, even with only the second correction we've seen in the stock market since 2011. Even, and actually, we're getting to the point where this stock, if we drop another few percent, the market's now going to drop more than it did in 2015, 2016, and now be the worst correction since 2011, right? And still, there's no change. Like, investors' intelligence started showing more bears than bulls in that 2015, 2016 correction. That just shows you how complacent people are.
Well, I want to say one last thing and then let you wrap up, and that is, okay, we're on this 200-day moving average. I'm just looking at that chart. I actually think if we fell to that 200-day moving average tomorrow or next week on Monday and just fell really fast, kind of like we did when the Dow fell off the January high. If we just dump really instantly 1,000 points in the Dow or something, we might see the low come in really quick. But if we instead float here and don't really move for a week or 2 weeks, then the decline will be even worse. The longer it takes to sell off from here, the more chances the decline will be bigger than it would have been otherwise.
Well, I just want to show you one more, just again to show you. Go back to that because it looks like to me, out of all these past crises or crashes, we're trading the most like Japan in 1990, right? When that bubble burst in Japan, right? So what I just want to show you here, so I just kind of make this a line chart. So what I just want to show you here is like okay, we fell more than Japan did on that first correction, and nothing's going to be exactly the same. Like Japan only fell about 5%. We fell about 12 or 13% of that first correction. But all I want to show you is I think something like this would happen. I don't know if we'll get a crash or a gap down day like you're talking about of 1,000 points. But I think what would happen is if we do break these lows of February, we get some kind of decline like this. Like I said, that takes the S&P down to, I don't know, 2,200, 2,300. And then we probably get a rally like this that we saw in Japan. And then we get another decline in the fall. And nothing, not going to say that's exactly going to happen, but that would be kind of my gut, is that if we smash through these lows here, we'll probably sell off very hard for a month or so. And then in probably May, then in May, June into the summer, kind of rally. And so that basically that drop in the Nikkei from the top was 39,000 to 28,000, 11,000 points. And the rally was about 5,000 points. It went to 33,000. So you do the math, let's say the Dow, I don't know, falls to 21 or 22,000. Well, that would be like 6,000 points, from the top. And then, from almost 27 to 21, then probably we could rally almost back to where we are now. Rally back 2,000 or 3,000 points or something like that. So anyhow, that's just my warning that if we break these lows, I do think something like this is going to start to play out. And by the way, the Nikkei was more overvalued than stocks are now today in the States. The Nikkei was trading at 60 times earnings, and that's why it fell almost 50% very quickly. Now we're at really high CAPE ratios, and on trailing earnings, we're trading at like 25 times earnings. So that's still not as extreme as what the Nikkei was doing. Now, granted, a lot of these earnings are inflated by financial engineering, but that just so you know, that's why the Nikkei's drop was so extreme. It was even way more overvalued than now. And actually, I just want to tell you one more thing, because we've been talking about Tesla. I really think that Tesla is going under, okay? And there's great articles on the internet. I just did an Elon Musk a con men search. This is Forbes here, and it's a great article that was written a couple of years ago, or a year ago, actually just last October, sorry. Is asking that are you drunk on Elon Musk Kool-Aid? And he's talking about there's all this bullshit that Elon Musk just talks. Right now, this new car that blows up all the time, the engines just go on fire after a crash and the whole car melts away. They can't even meet the production targets for it. Now, some people say there's no demand. I don't know about that, but I just know that it's a badly run company, and he can't produce the cars. Either there is really no demand for them, or he can't produce the cars that he needs. And either way, it's a disaster. So this is an article, which is a great article about, and I always compare Musk to DeLorean in that they were kind of almost became these kind of cultural icons. Both were trying to do these new cars, competing with, the big car makers. Both were trying to do kind of cool sports cars. Both got government money. DeLorean got government money from the British government and was building the cars in Northern Ireland. And obviously Musk has done the same thing in California. And then this is the story here in the New York Times in 1982 when DeLorean went bankrupt. And one thing that's interesting too is that DeLorean got accused of taking money out of the company to benefit himself before the bankruptcy. And then recently Musk tried to give himself all these a couple $1 billion worth of options. Then a lot of the shareholders, especially the larger shareholders, actually rejected him on that too. So there's these kind of interesting similarities. And then whenever Musk confronts a problem with the production numbers, he just starts talking some bullshit about going to Mars and just like nonsense, and it's just, even I think the other day after this crash happened and this fatality happened when the car blew up and went on fire, he just, the only thing he does, like something on his Facebook or Twitter page, someone asked him about Mars, or and he responded to that. So this is how he kind of deflects things whenever there's some kind of negative financial news on the company.
Yeah, it's quite an amazing situation. The thing about DeLorean, like you said, he was a big shot, during his time, and now no one knows his name, and that's probably what's going to happen to Musk too.
Well, the only reason they know DeLorean's name is because the car was in Back to the Future, right? It's like, if it wasn't for that, really no one would know who the hell the guy was. And let me give you one more example. There's always signs with these guys. Musk last year, two more examples. Last year, he started bashing all the shorts. I always think that's a big red flag because, Steve Jobs, Bill Gates, real CEOs don't start, attacking shorts, right? And usually guys who do know because there's a reason that people should be shorting their companies, right? So that's number one. And number two, he bought another famous car from a movie, the James Bond movie, The Spy Who Loved Me. There's a Lotus, which is a British sports car that turns into like a submarine and goes underwater. Well, that's actually a real submarine that they made look like a car. And this submarine turned up in somebody's garage years and years later after the movie, and then just got auctioned off, and Musk bought it. And he was trying to turn this submarine into like the car in the movie that would transform from a car into a submarine. And later on, he said he couldn't do it. And then, he's just going to leave the submarine. And the only thing I'm saying about stories, that's just how full of shit this guy is. He's trying to make this thing into a transformer thing from some movie, doing crap like that. And to me, stuff like that is always like a warning sign, right? Like, he's doing crap like that. He's bashing the shorts. He's talking about going to Mars. These things are just like nonsense. And what happens is he's created like a cult following, right? Because he's created this cult following because people think that he doesn't care about money. Oh, he's doing solar power. Oh, he's doing electric cars. Oh, he's some CEO who cares about the environment. And people ignore this is a bankrupt company. They have $9 billion in debt, right? Only $11 billion in sales.
And about cash flow. I mean, that's no other way to put it.
Yeah. Anyhow, so all I'm trying to say is he's created this kind of cult following, and people have ignored that. Like, he was able to sell these bonds at like 3-4% yields, even though his balance sheet is junk. And by the way, those bonds now, based on the current price of the bond, are yielding 7%. And that's really bad because every year, because Tesla burns through so much money, they have to keep issuing bonds. And let's say they sold stock, right, to raise money instead. Let's say they decided to sell, 1 million shares of stock. to raise 250 million. That's what it'd be right now. Well, that's just going to dilute it and make the stock tank even more.
Yeah, it's really a toxic stock situation for shareholders right now. I mean,
the stock's going to zero. That's my opinion. So.
It probably is. It's going to be a crazy story. Well,
just to finish, sorry, Mike, one more thing. I'm kind of ranting here, but that just shows you too, though, it's so hard to short because to me, this stock for years and years has been the most obvious company that's going to go to zero. But, you see this I got a 4-year chart up, and the stock went from, from roughly 200 to almost 400, went to 380. And that was despite the fact that it's so obvious from the financials, this is a bankrupt company. It's just really, really difficult when you're in a mania.
Yeah, until the mania is over. Well, thanks for talking to me and everyone else. And, the stock market is closed on Friday, so have a good vacation from all the madness that's going on.
Yeah, people can relax. Hey, if you're on margin, you don't have to worry about a margin call this Friday.